What if I told you that some of history's most celebrated figures were actually master tax dodgers who would make today's accountants jealous? From ancient Roman emperors to American founding fathers, the wealthy and powerful have been playing chess with tax collectors for thousands of years, and their strategies were absolutely brilliant. Today, we're diving deep into the shadowy world of historical tax avoidance, where fortunes were hidden, empires were built on loopholes, and some of the greatest minds in history spent their time outsmarting the taxman. Trust me, by the end of this video, you'll never look at your tax return the same way again. But first, let's talk about why this matters today. The techniques these historical figures used didn't just disappear into dusty history books. Many of their strategies evolved into the sophisticated tax planning methods used by corporations and wealthy individuals right now. Understanding these historical precedents gives us incredible insight into how our modern financial system actually works. Let's start with arguably the most famous tax rebel in American history, John Hancock. Yes, that John Hancock, the guy with the giant signature on the Declaration of Independence. Before he was signing documents that would create a new nation, Hancock was running one of the most successful smuggling operations in colonial America. Hancock inherited his uncle's shipping business and quickly realized that British taxes on imported goods were crushing his profit margins. So what did he do? He turned to smuggling on a massive scale. His ships would dock at remote locations along the Massachusetts coast, unload their cargo in the dead of night, and transport goods to Boston without paying a penny in customs duties. The British authorities knew exactly what was happening, but Hancock was incredibly clever about it. He maintained legitimate shipping records for some cargo while running completely separate books for his illegal operations. When customs officials tried to search his ships, mysterious crowds of Bostonians would appear to intimidate the inspectors. Hancock's tax resistance wasn't just about money, though that certainly motivated him. His smuggling operations helped fund the early resistance movement against British rule. In essence, he was using tax avoidance as a form of political protest that would eventually contribute to the American Revolution. Moving across the Atlantic and back in time, let's examine how Roman Emperor Augustus created one of the most sophisticated tax systems in ancient history, then promptly figured out how to game his own rules. Augustus understood that direct taxation was politically dangerous, so he implemented what we might recognize today as consumption taxes and tariffs. But here's where it gets interesting. Augustus and his inner circle systematically exempted themselves from many of these taxes through a complex web of legal privileges and ownership structures. The emperor would technically own vast estates and businesses through intermediaries and family members, making it nearly impossible for tax collectors to determine his actual wealth. He also established special legal categories for imperial property that were conveniently exempt from most taxation. Even more clever was Augustus's use of what we might call today offshore banking. He kept significant portions of his wealth in territories that were technically outside the Roman tax system, accessible through trusted agents who could move money without creating official records. Now, let's jump forward to medieval times and explore how the Catholic Church became perhaps history's most successful tax-avoiding institution. The Church didn't just avoid taxes. They turned tax exemption into an art form that lasted for centuries. Church leaders understood that their spiritual authority could be leveraged into financial immunity. They argued that taxing religious property would interfere with their divine mission. And surprisingly, most rulers bought this argument. But the Church didn't stop at simple exemptions. They developed incredibly sophisticated methods for acquiring and holding property through complex ecclesiastical structures. A single monastery might technically own dozens of separate properties, each held through different legal arrangements that made taxation nearly impossible. The Church also pioneered what we might recognize today as charitable tax shelters. Wealthy individuals could donate property to the Church, receive spiritual benefits, but retain practical control through family members who became church officials. It was a medieval version of the modern charitable remainder trust. Perhaps most ingenious was how church institutions used their international structure to move wealth across borders. Money could flow from England to Rome to France without passing through any single jurisdiction long enough to be effectively taxed. Moving into the Renaissance, we encounter Leonardo da Vinci, who applied his legendary creativity to tax planning with the same genius he brought to art and invention. Da Vinci understood that his value as an artist and inventor made him incredibly mobile. When tax burdens became too heavy in one Italian city-state, he would simply relocate to another jurisdiction, offering better terms. This geographic arbitrage allowed him to maintain his lifestyle while minimizing his tax obligations. But Leonardo was even more clever than simple jurisdiction shopping. He structured his income streams through multiple sources: direct commissions, workshop sales, consulting fees, and even early forms of licensing deals for his inventions. By diversifying his income types, he could take advantage of different tax rates that applied to various categories of earnings. Leonardo also pioneered what we might call intellectual property tax planning. Many of his inventions and artistic techniques were kept as closely guarded secrets, allowing him to license this knowledge without creating easily taxable income streams. Fast forward to 18th century France, where Voltaire turned tax avoidance into a philosophical principle. Voltaire believed that excessive taxation was a form of tyranny, so he felt morally justified in minimizing his contributions to what he saw as an unjust system. Voltaire's strategy was brilliantly simple. He invested heavily in tax-exempt government bonds and securities that provided steady income without direct tax liability. He also purchased multiple properties in different jurisdictions, allowing him to claim residence wherever tax treatment was most favorable. Perhaps most interesting was Voltaire's use of what we might call reputational arbitrage. His fame as a writer and philosopher made him welcome in courts across Europe, where he could negotiate special tax privileges in exchange for his intellectual contributions and social prestige. But let's talk about Benjamin Franklin, who might have been the most sophisticated tax strategist of his era. Franklin understood that the key to tax optimization wasn't avoidance, but rather strategic timing and structure. Franklin built his wealth through multiple income streams: printing, publishing, real estate, and various business partnerships. But he was incredibly strategic about how he structured these ventures. Many of his businesses were organized as partnerships or early forms of corporations that provided liability protection and tax advantages. Franklin also pioneered what we might recognize as retirement tax planning. He systematically reinvested profits into appreciating assets rather than taking taxable distributions, allowing his wealth to grow while minimizing current tax obligations. Even more impressive was Franklin's understanding of international tax arbitrage. His diplomatic career allowed him to maintain residences and business interests in multiple countries, enabling him to optimize his tax situation across different jurisdictions. What makes these historical figures so fascinating isn't just their creativity, but how their strategies reveal fundamental tensions between individual wealth building and government revenue needs that persist today. These historical tax strategies teach us that the wealthy have always found ways to preserve their resources, regardless of the legal framework. The specific techniques evolved, but the underlying principles remained constant: diversification, jurisdiction shopping, timing optimization, and structure sophistication. Understanding these historical precedents helps us recognize that modern tax planning didn't emerge in a vacuum. Today's complex strategies have deep roots in techniques developed by some of history's most brilliant minds. The lesson isn't necessarily that we should emulate these figures, but rather that we should understand how tax systems really work in practice, not just in theory. The gap between written law and actual enforcement has always created opportunities for those clever enough to exploit them. What's your take on these historical tax strategies? Do you think these figures were brilliant entrepreneurs or tax cheats? Let me know in the comments below. And if you found this exploration of financial history fascinating, subscribe for more deep dives into how the past shapes our present economic reality.